Over the past year, most of the attention in metals markets has been on gold and silver. Gold has pushed to record levels. Silver has moved sharply, and both have been widely discussed across financial media. But while that was happening, a much smaller and far less discussed market moved even more aggressively, and did so with very little commentary at all. That market is platinum. I want to be clear about why this is worth your time. This is not a video about predicting prices, and it's not a recommendation to buy anything. What I'm interested in here is sequence. How pressure shows up in a financial system, where it tends to appear first, and what kind of signals can help you interpret what may come next. Platinum is useful precisely because it sits away from the center of attention. When markets like this move sharply, it often tells you something about underlying conditions before those conditions become obvious in the assets everyone is watching. Welcome to Money and Power. Let me set expectations properly. This is not about chasing a move that's already happened. It's about understanding what kind of environment we are moving into, so you're less likely to misread later signals in gold, equities, credit, or currencies. The practical value here is orientation, not action. Over the last 12 months, platinum has behaved in a way that is very unusual for that market. From lows around $900 an ounce, it moved above $2,300. At one point, that represented gains of more than 140% year on year. That is not how platinum normally behaves. Platinum is usually quiet. It trades in ranges. It goes long stretches without attracting much attention. It's not something most investors follow closely, and it rarely features in everyday market discussion unless there's a very specific supply issue. So when a market like that moves sharply, without becoming a dominant story at the same time, it's worth pausing and asking why. Not in an excited way, and not in a predictive way, but in a diagnostic one. Now, to understand why this matters, it helps to compare platinum with gold. Gold has also risen strongly over the past year. Depending on how you measure it, gold has been up around 60 to 70% at its highs. That move has been widely discussed and broadly understood. Central banks have been buying. Financial media has covered it consistently, and retail investors recognize the narrative. Gold's behavior makes sense in the context of high debt levels, persistent inflation concerns, and growing unease about long-term financial stability. Gold is doing what gold has done historically in similar environments. Gold's move is important, but it isn't surprising. Platinum's move is different. Not because platinum is more important than gold, and not because it replaces gold in any monetary sense, but because it reacts to a different part of the system. One way to think about this is that gold tends to move when confidence breaks. Platinum tends to move when structure tightens. Gold is deep and liquid. It absorbs large flows of capital and responds over longer arcs of time. Platinum, by contrast, is a much thinner market. Supply is more concentrated, inventories are smaller, industrial demand is harder to substitute in the short term. That means platinum has less buffer. In complex systems, pressure doesn't usually show up first at the center. It tends to appear at the edges, in places that cannot absorb shocks as easily. Thin markets, constrained supply chains, and assets that sit between categories often react earlier than large liquid markets. Platinum sits very close to that edge. Its supply is geographically concentrated. A large proportion of global production comes from a small number of regions, most notably South Africa. Mining output is not flexible in the short term, and operational issues such as energy supply, labor conditions, and infrastructure constraints matter. At the same time, platinum demand is not purely discretionary. It is tied to industrial processes where substitution is limited or costly. That makes price responses more mechanical than emotional. When pressure builds in that kind of market, prices do not adjust gradually. They tend to reprice. This isn't speculation in the usual sense. It's the system responding to constraint. Another important feature of platinum is that it doesn't sit neatly in a single category. It isn't purely a precious metal, and it isn't purely an industrial metal either. It exists in between. That ambiguity keeps it under-owned and under-analyzed, especially during periods when liquidity is abundant and financial assets dominate attention. But the same ambiguity makes platinum sensitive to tightening conditions. When money is cheap and supply chains are loose, that in-between status doesn't matter much. When refinancing costs rise, logistics tighten, and substitution becomes more difficult, assets that straddle categories often reveal stress earlier than those that sit clearly in one camp. This is where the current environment matters. Over the past few years, a number of assumptions were made about energy transitions and industrial demand. Full electrification was widely expected to arrive quickly. In practice, that transition has been more complex and more uneven. Instead of a clean move to fully electric vehicles, much of the world has pivoted towards hybrids. That matters because hybrid engines require catalytic systems that depend more heavily on platinum group metals than many fully electric alternatives. At the same time, supply remains concentrated and fragile. When physical demand collides with a market that has limited flexibility, prices don't adjust politely, they adjust abruptly. We're also seeing substitution effects elsewhere. With gold trading at historically high levels, it has become less accessible for certain uses, particularly in jewelry markets. In response, some demand has shifted back towards platinum as a relative value option. Now, that doesn't mean platinum is cheap in any absolute sense. It means the price of certainty, represented by gold, has risen enough to change behavior at the margin. When substitution begins in areas that are traditionally conservative, it's usually a sign that underlying conditions have shifted. Now, I want to stress something important here. This is not about saying platinum is better than gold. Gold remains the primary monetary anchor in periods of systemic stress. Central banks do not hold platinum as a reserve asset, and platinum does not replace gold's role in the financial system. What platinum does instead is move earlier. Gold tends to confirm what has already become broadly recognized. Platinum often responds when conditions begin to tighten, but before that tightening is widely acknowledged. Different assets, different roles, same system. Now this distinction matters because it helps you interpret what comes next. The practical value for you as a viewer is not that platinum has gone up. The practical value is that it helps you understand the stage we are in. Most people struggle in markets not because they lack information, but because they misread timing. They react to loud signals once they're already embedded in prices, and they miss quieter signals that appear earlier and feel easier to dismiss. Platinum is one of those quieter signals. It doesn't tell you what to do tomorrow, doesn't tell you where prices will be next month. What it does tell you is something about the environment, about how much slack remains in the system and where pressure is beginning to surface. So why hasn't this been discussed more widely? Partly because platinum doesn't fit a simple narrative. It doesn't align neatly with inflation stories, monetary policy debates, or growth themes. It raises questions about supply fragility and industrial dependency that are uncomfortable and difficult to reduce to headlines. Markets, like people, tend to prefer familiar explanations. Signals that don't fit established stories are often discounted until they become harder to ignore. That doesn't mean they aren't real, it just means they are inconvenient. If you zoom out and look at the broader backdrop as we move through 2026, a move of this magnitude in a thin market like platinum suggests that some of the buffers that existed during years of abundant liquidity are no longer there. That doesn't imply collapse. It doesn't even imply inevitability. It implies that the margin for error is narrowing. In environments like this, commodities often tell uncomfortable truths before financial assets do. Physical constraints matter more when capital becomes selective and refinancing costs rise. Platinum fits that pattern. It's also important to say what not to do with this information. A signal is not an instruction. Seeing a sharp move in platinum does not mean you should rush to act on it. That would be reacting literally rather than analytically. The value here is context. Understanding signals like this helps you avoid misinterpreting later moves in gold, silver, equities or credit markets. It helps you distinguish between noise and confirmation, and it helps you remain oriented when markets send mixed messages. For those of you who follow precious metals closely, this sequence may already feel familiar. Gold tends to confirm, silver tends to exaggerate, and platinum often speaks first. Recognizing that sequence allows you to observe price movements without being pulled into emotional reactions. It allows you to ask better questions. What kind of environment produces this behavior? What constraints are beginning to matter? And where might pressure surface next? Platinum is not the answer to those questions. It's a lens through which to examine them. Peripheral markets are often where stress leaks out first, not because they're more important, but because they are less protected. That doesn't mean prices won't pull back, consolidate, or even behave erratically. It doesn't mean narratives won't change. It simply means that something is tightening somewhere in the system, and platinum is sensitive enough to reflect it early. That's information you can use, regardless of what you hold. Now, if you find this kind of big picture analysis useful, analysis that focuses on interpretation rather than excitement, then please like the video. Subscribe to the channel and enable notifications. It helps this work reach people who value clarity over noise. And remember, platinum doesn't shout, but it often speaks before others do. Now, before I finish, I want to ask you something directly. Over the last few weeks, a number of viewers have asked whether I could go deeper into some of these ideas, not just reacting to headlines, but stepping back and explaining how the pieces fit together, what actually matters and what doesn't. Now, that could take different forms. For example, longer and more detailed videos, written briefings that pull the analysis together, or even occasional live sessions where I walk through a theme in depth and answer questions. Now, I haven't built anything yet. The reason I'm asking now is that producing that level of structured analysis would require a meaningful amount of focused time, and it would only make sense to do that if it genuinely adds value for people watching, and if it's something they'd actually use. So I'm trying to understand two things. First, whether that kind of deeper, more joined up analysis will be useful to you, and second, only if it is, whether it's something you would ever see as worth paying for, at a level that reflects the depth and effort involved. Now, if it would be useful, let me know in the comments. And if you're comfortable doing so, it would also help to know what sort of format you'd value most. Video, written analysis, live sessions, or a mix. And roughly, what level of monthly cost would feel reasonable to you. That feedback will guide whether I take this any further or not. If you'd like to watch another video, there are a couple on screen now. Thank you for watching, and I look forward to reading your thoughts, and I'll see you in our next video.